In this episode of the Construction Lending Podcast, Matt Jones, Associate Vice President of Government Housing Finance of the Mortgage Bankers Association, joins us to discuss policy issues dealing with housing supply deficits, agency repurchase demands, and liquidity strategies. We address the current state of political affairs on Capitol Hill and discuss the potential bipartisan nature of housing policy amid political gridlock and looming elections.
What we really are looking for is a immediately poolable, single close construction to perm program that would be delivered to Fannie and Freddie. We know that USDA has such a program, which I know you know a little bit about. We love that. USDA is like the poster child of what could be possible. It's just a question of willpower, whether it can be done without Congress, whether it can be done as a reinterpretation of the congressional charter, or if need be, do you make changes congressionally to what the GSEs are able to do? If this is this much of an emergency in the American economy, at some point you got to ask that question. We've been very vocal advocates that the FHA 203K renovation programs are not being utilized nearly as much as they can be.
I'd like to welcome everybody today to the Construction Lending Podcast. I'm your host, Sean Ferris with Langrel, and we got a really different, fun, and exciting guest for you today. We've got Matt Jones, who comes to us as the Associate Vice President of Government Housing Finance with the Mortgage Bankers Association. Welcome, Matt.
Thanks for having me.
Well, this is exciting to us because one of the first things that I noticed when we started talking was doing a little research on your background and seeing the work that you've done in the political world and kind of looking at your resume and your background. How did you get from doing, how did you get into this role? It's such a unique role with the MBA.
Sure. So, and I think my path is a little bit different than a lot of folks, because a lot of folks in DC will start in policy and then they'll learn the expertise later. I did not grow up in policy. I grew up in the mortgage banking business. My family had a mortgage company, recently has been acquired. But when I was growing up, the conversations around the dinner table were always about Fannie and Freddie and about, loan officers and production teams. And when I was in high school, QM and safe harbors and all the new CFPB regs. So I kind of lived and breathed that stuff. And then I eventually made my way out to DC and found my way into policy, where certainly my having been a loan officer previously was fairly unique. I am also an attorney by training, but I think my loan officer background, at least so far, has been more valuable than being an attorney. So
you don't meet very many loan officers that are attorneys and have practiced policy. Like, you've really got this well.
You know what it means is I was a really crappy loan officer. That's what it means, because I had to move on.
Oh, and I don't think, I come from a very, not similar background, but similar experience where our dinner table conversation was around construction lending and mortgage. And I don't think our parents knew, well, maybe your parents did, but my dad knew at the time that, the impression that he was making on me would, lead to my career path here and develop construction lending software, right? So it's amazing to think about that. And if you've got kids, be careful of those dinner time conversations, because you never know where we're going to end up. But yeah. So you're over at the MBA, and just with a little bit of background, why don't you tell us, kind of what the MBA is up to and, what your role is over there at the MBA?
Sure. So MBA is the national trade group for the mortgage banking industry. We have both residential members, anything from the large commercial banks to credit unions, community banks, independent mortgage bankers or IMBs, as well as members in the title underwriters, mortgage insurers, law firms, kind of run the gamut, as well as commercial multifamily members. And we have a bunch of hats, but I'd say really the principal role of us as a trade group is advocating for policies that benefit our members. As in addition to the advocacy we do, we've got a research and economics team that the whole marketplace, I think, knows and trusts on the data we put out. Education, we put on a bunch of meetings. We're really the primary convening force for a lot of industry events. But in the policy space, particularly, let's face it, in the mortgage business, 3/4 of all mortgage loans originated one way or another end up through a government conduit, whether it's Fannie and Freddie or a Ginnie security. And so, in our view, it's paramount to remain engaged with those agencies on their policies. They're the gatekeepers for what we can and cannot originate, the borrowers we can and cannot serve. So MBA plays that role of having, building relationships and engaging on an hourly basis with the folks in DC that influence the way our business works. So we've been doing that for a long time. Our policy shop has about 15 to 20 individuals like myself on it that all specialize in various sectors of the mortgage business. We also have legislative affairs, so engaging directly with Congress. We have a team that works in engaging directly with the GSEs, with FHA, VA, and RD. And then we also have a state and local team that follows and tries to influence at least all the state level legislation and regulatory actions that obviously impact everything we do as well. So we're a lot of places at once, and we like to think we're kind of the folks that our members can turn to for advice on how to influence the policy conversation around mortgage banking.
No, that's great. With that said, what are kind of the big hot topics that are happening at the MBA? What do we need to know about?
Sure. So, while we're working on a whole bunch of things all at once, the three priorities that we have in particular this year, and I don't think any of them will be a surprise. Number one is housing supply. Clearly, we all are seeing the backlog of housing inventory, particularly in the starter home, entry level price point, and we're seeing, household formation continuing to outpace new home construction by about 600,000 a year, and that's showing little sign of slowing down. So the structural backlog is getting worse each year. And I know, to some extent, there's not a whole lot we can do to really influence the ability to build more, but we are identifying and seeking to push on the levers we do have. So things like, how do we make construction lending more feasible, which we can get into later, looking at things like renovation lending, and are the current reno programs at the GSEs or FHA being used to their maximum potential? We think certainly they're not. And then looking at local red tape, like you can't have the conversation about housing supply without a conversation about zoning. And are there ways that we can provide incentives to local jurisdictions to build more and address some of this that way? So housing supply is a major focus that we're working on every day. Another one is agency repurchase demands, which clearly in a market we're in where rates have gone up, having to buy back a loan that was originated in the 2021 or 2022 vintage in order to scratch and dent, that's a 20-point haircut. And that's just going to be completely a bomb for any lender to have to eat that back. And if it's a performing loan, which most of them are, there ought to be better mechanisms to work through those issues. Clearly, the GSEs are the counterparty of these lenders, and there's a way to work these things out. We just went through a very challenging market cycle, but the quality of underwriting has not significantly changed. Why are we seeing a change in the repurchase demands that our members are experiencing? That would be, I think, priority number two. And then priority number three is having seen what we just went through with COVID, and to the extent that there are concerns, real or imagined, about the liquidity risk of people who are servicing loans, particularly servicing government loans within the Ginnie Mae program, how are there ways that we can improve the liquidity in the system so that we prepare for the next market downturn? Because we all know this is a cyclical business. Are there ways that we can work with Ginnie Mae and others to build and enhance the current system so that we know the next time there's that downturn, we can have more peace of mind that the system is going to be in a really strong place, really resilient, regardless of what we see next. So those have been our three major pushes in terms of our residential priorities for the year.
Oh, that's great. Well, specifically on the topics, what are you seeing, any hot topics on Capitol Hill, changes with the GSEs? I know there's some stuff about energy efficiency rules with HUD and USDA. What kind of specific topics out there are you seeing?
Sure. So on Capitol Hill, they're gridlocked, right? So you have a Senate that's controlled by the Democrats and a House that's controlled by the Republicans. And so that inherently there's going to be some disagreement between the chambers. The good news about housing policy is a very bipartisan topic. There's plenty of opportunities where folks are willing to come together. Housing affordability is one of those topics where you can find some I'd hesitate to say consensus, but at least strong bipartisan support. However, I think the prospect of any major legislating this year is low, not only for the gridlock, but also the fact that we're an election year. And the conventional wisdom is as you get closer to November, an election year, legislating tends to slow down to a trickle, if anything at all. So I think the prospect for Congress to do much this year is low. Though I would note many of the Trump era tax cuts, that many of which our industry is very appreciative of, are scheduled to sunset in the following year in 2025. And so we do see the potential for those, whether many of those tax relief provisions are going to be extended, is an open question that we think will put a lot of momentum behind potential tax reform in 2025. So we saw from the Biden administration very recently a variety of tax proposals that are specifically geared to the housing supply problem we talked about. Incentives for first-time home buyers to help bridge their down payment barrier, which is typically the biggest barrier for most first-time home buyers, is coming up with the cash to close. And then things on the seller side too. So we all have seen this lock-in effect where if you're sitting on a 2.5% or 3% interest rate in this market, you're not willing to sell and put your house on the market. And why would you? Because you're going to have to give up your really advantageous interest rate. So we've seen a proposal to provide tax incentives to maybe move the needle on getting more people to list their homes. Again, we view a lot of those as placeholders for what could be a real chance at tax reform when those Trump era provisions are scheduled to sunset in about a year and a half. So be on the lookout for that. But Congress is thinking about housing supply all the time. They're doing a lot of hearings. They're getting a lot of witnesses to come in. And clearly every member of Congress, not surprisingly, is hearing from their constituents constantly about how am I going to get on, if I'm a first-time home buyer, how do I get onto this ladder that feels like the ladder's being pulled out of reach just to buy an entry-level home? And it's challenging, and it's felt practically everywhere. Housing prices combined with where interest rates are going, that sentiment is everywhere, and Congress is trying the best it can to be responsive. So that's the overview on Capitol Hill. I would then say the administration is trying to find any opportunities that it can act administratively through the levers it controls, like Fannie Mae and Freddie Mac, because FHFA, its regulator, is also the conservator. How can we influence Fannie and Freddie to help with this supply problem? How do we push through FHA some policy changes, and through VA? So those are the levers that the Biden administration is thinking about, to the extent that they are similarly bearish that Congress can do much this year. What can they do through the agencies to influence change is certainly what's on their mind as well.
Speaking of policy change, is there stuff that's close to the finish line that looks like it's going to materialize, or some policy change that just has not taken effect yet, that you see impacting members of the MBA?
Yeah, so a couple recently. So one major issue that we've been following very closely is the Veterans Assistance Servicing Purchase Program within VA, which was just rolled out earlier this week, actually. And really the issue there is you have about 75,000 veterans that are currently seriously delinquent and have been delinquent in most cases since early COVID. During COVID, FHA, VA, USDA had the ability to do on a temporary emergency basis, effectively a partial claim where a borrower that goes into COVID forbearance, their arrearage of missed payments can be placed on the back end of the mortgage that's paid off when they either sell the house and move, or at the end of maturity. That is the notion of a partial claim, and then the lender gets the amount back up front, and then the loan can continue as it was. That's not a permanent authority that VA has, and unlike all the other programs, that sunset. And so now you have, like I said, 75,000 veterans that are sitting at the end of the loss mid options that currently exist within VA, and especially given where interest rates have moved, it's really, really challenging to think about how you could mod them into the current market and have them be able to get back on their feet. A partial claim option would be very advantageous. So we've been trying to get Congress to give VA that authority to do it. Why did the vets have less advantageous loss mid options than an FHA borrower, for example? So that's something we've been pushing on. What VA just announced in VASP this week is VA would, if no other options are available to the veteran, effectively buy that loan from the current servicer and hold it on its own books, and then work with the veteran directly to try to get them back on their feet. Our view has been, we think VASP is a helpful step, but not a panacea, and that they should roll out that partial claim option as well. But that's something that VA just announced this week. Another one, which if you'd like, we can get into, is HUD and USDA have a proposed rule on energy efficiency standards, wherein effectively they're saying that new constructed homes have to meet, in order to be eligible for FHA and USDA financing, have to be built up to the 2021 International Energy Conservation Code. And the problem with that is only, I think, 2 or 3 states currently have adopted the 2021 standard. About 47 states have not, and in many cases are over 10 years behind the current standard. So in effect, the government is trying to influence the state jurisdictions to update their code. If they don't, then basically, sorry, you're out of luck. The new constructed houses can't get FHA financing and can't get USDA financing. And we all know that
that's a big deal.
It's a big, yeah, it's a big chunk. It's approximately 1% of all new homes every year are the new constructed ones in terms of purchases. And so to say that you're just going to completely wipe out FHA and USDA, the more affordable loan programs in a lot of cases, you're wiping out, for a lot of first-time home buyers, the opportunity to buy those newly built homes. It's really a question about prioritization of energy code versus affordability. And I think if you ask most voters, what's more important to you, the ability to buy a house or having a house that has tighter windows, right? And you have maybe a little bit lower of a utility bill. While that's a noble thing, right? I think most people would prioritize being able to buy a house. And what our math has shown is, in order to come, if you're a state that is currently on, say, the 2008 or 2009 code, to come up to the 2021 code, that represents between $15,000 and $25,000 of additional cost to buy that house, which clearly that's going to push it out of affordability for a lot of people. And the other point too is, in the jurisdictions that aren't up to the 2021 code, there aren't folks in the state that understand the 21 code. So even educating on it would be a bandwidth challenge, and it just would be, I think, frustrating all around. So we've worked jointly with the home builders in fighting that one. Our understanding is it's imminently about to be finalized. And so, we've expressed those concerns repeatedly, but that's one also to keep an eye on. We think it's a policy mistake.
Yeah, I mean, that's just, you're running into a wall on that one. Does that affect both the purchase of a brand new home as well as purchase of an existing home, or existing homes that haven't been occupied before somehow exempt under that?
So the good news is it would only be prospectively to new construction. If you applied it retroactively, you'd basically shut out all homes from the FHA program, right? Or a lot of them at least. I should also note, I'm on the single family team. This also affects multifamily. So rentals would also have to comply with these same requirements. And so all of the same concerns on the ownership side would also apply in the rental market, and of course would correspond to higher rents, because those costs to acquire the property and build the property will inevitably be passed through. So it's as much of and arguably more of a concern in the rental housing space than it is in single family.
So this would apply to proposed construction, right? Like, hey, the house would have to be built with these energy efficient standards in place, as well as a home that's already been built. That's, hey, this is going to be the financing for this brand new home being purchased. I mean, that's what was the percentage of homes that you say that would be impacted by this, or percentage of mortgage transactions?
So in round numbers, our math is about 1% of purchases are to newly built, new construction, single family homes. But then that adds up, right? So each year you're basically canceling out another 1% of the market that is ineligible for FHA financing. Unless the states, and this is what the federal government effectively is trying to do, right, is compel the states to update their code using the lever that they have. So the states can choose to do that. But it's, in a lot of states, again, the lift to get to the updated code is not just like a waving a wand and updating. It's about training the field on how you build a home and everything that entails, right? It's not an easy lift by any stretch. So,
and it seems that even though the home may meet those standards, if the state hasn't set the standards yet, then the financing wouldn't be available to them.
If the home is built according to the code, then it would be eligible for FHA financing. I think the problem is that the builders in a lot of states are not currently working with the 21 code, because in most states those are not the standards, right? So you could go above the standard, and I should check at the front here. I'm a mortgage guy, not a builder guy. But if you build with up to the 21 code, then you will be fine with being eligible for FHA. But that would be a new step for a lot of builders in a lot of jurisdictions that they're not currently. There's no reason to have to comply with it.
Yeah, I'm putting on my construction lender, hat now and trying to think, well, hey, if I'm going to make a loan, in a state where they haven't set those standards to the 2021 standards, but I want to provide construction financing for this home being built. How do I know that, or how do I evidence and prove, in the file that it is and will meet those standards? Is it just simply an attestation, notarized document from the home builder, or does it have to go through some sort of architectural sign off that, hey, it's going to meet these standards? I don't know if you'd even know the answer to that, but I'll ask.
I don't know. Yeah, again, we're hoping we can fight it so we don't have to live in that world. But you raise a good point, which is that you have to build a house assuming that the person buying it may be an FHA borrower, and therefore it influences how you build the house, and that shouldn't be a consideration necessarily. If particularly in a price point where you'd see more FHA borrowers, that's going to effectively compel you to build with the code every time. It's hard to build a house based on which type of financing the potential buyer without having that information, right? So you'd have to err on the side of being conservative. So yeah, it raises all types of issues. And we've expressed those repeatedly through formal, comment letter, as well as informal channels and conversations with the White House and OMB. And I think they know where we stand. Again, it comes back to, how do you prioritize between housing affordability and rental affordability and energy efficiency, which, of course, having tighter built homes is a valuable thing. It's just, is that worth paying an extra 30 grand for it? In my opinion, it is not.
Yeah, it reminds me about the regulatory costs that, and the National Association of Home Builders publishes these statistics every every year, but how much regulation actually goes into the cost of building a home. And I want to say it's 25% nationwide, and it just grows every year. And then in California, I think it's like about 33% of all costs that are related to build that home go to, government authorities, or, some sort of regulation that's put in place that you got to do this thing, or health and safety standard. And we're not talking about single digit 1%, 2%. We're talking about a third of the house in California, or a quarter of the house in most other states. And that's just mind-blowing.
That's exactly right. And I know our economists have the official number. I know it's in the mid-thousands per transaction just in regulatory costs, the lion's share of which have come post Dodd-Frank, right? And the advent of the Consumer Financial Protection Bureau and its approach to regulating, where lenders have to basically guess conservatively on what the rule is. And if you're wrong, then they'll penalize you without saying what the rule was prior to the penalty, right? So that entire culture around regulating has forced lenders in a lot of cases to be unduly, in our opinion, conservative in all of their underwriting practices and all of their regulatory practices because of this culture of the CFPB not necessarily saying clearly what the rule is, regulating by blog post or by enforcement, rather than an actual rulemaking that there's a notice and comment opportunity to opine on, and an implementation period to actually understand and collaborate. That's not what we've seen. We've seen unpredictability, and in a market of regulatory uncertainty, the prudent lender is going to be more conservative, right? And not play in the area where maybe there's gray area, but that's called expanding the credit box slightly so you can serve more people. So there's always a tension there.
If I wanted to kind of understand time frames, say I've got a pipeline of loans I'm trying to close, is this something that we're going to see materialize and go into effect 3 months from now? Hey, this looks like next year. Like, is there any kind of time
on the energy efficiency rule? I would anticipate it would have a delayed implementation date, so it would not be likely to affect current transactions in the pipeline.
And is this one of those things that, hey, as more and more people become aware, and state governments become aware, and the just general awareness of, hey, here's this train that's about ready to crash, they're going to become more vocalized, and we should see some more activity over this issue of resistance?
Yeah, I think once it starts to actually impact deals, and it's less of a theoretical exercise, I would expect to see much more pushback. Yeah.
What we'll do is we'll include links on where they can find more information and follow you on the MBA regarding this within the podcast here. But wow, that's just such a big one here. You mentioned some other rulings here, and immediately my mind jumps to all the National Association of Realtors news, and what's happening out there. And I'd love to get your expert opinion. What does that mean for the mortgage industry? What are we likely to see, and what the heck is happening?
That's a great question. And, I thought this might be the one call of the day where we didn't have to talk about the NAR settlement, but happy to dive right in. So our base case is that we don't know exactly how things will play out. We think markets will be different based on the custom of the market. We think there will be markets where the listing agent continues to pay the commission on both sides. There's certainly a fair amount of inertia in the marketplace for doing that. Whether it actually results in lower commissions overall, I think jury's still out on that question. There's potentially more ability to negotiate the commission up front with the buyer agent, but a couple kind of guardrails that MBA has been worried about. Number one would be, we think it's a mistake for a buyer, particularly a first-time home buyer, to go unrepresented into the transaction. We do think that partnership with a buyer's agent is very important in the transaction. Number two is financing commissions is a mistake. Not and a lot of the coverage around financing commissions, in our view, misses the cost also of additional mortgage insurance and just financing an extra 3% at 7% over the life of the loan. That's what, three times the cost of the commission up front. So we think that's not a good outcome. One thing we have been working on is in a world where it's not just the default where the listing agent is paying the commission, do we have a challenge with the deals where the listing agent does in fact pay the commission being labeled as an interested party contribution or a seller concession, right? Where there's current caps in place around how much with certain programs can be a seller concession. We did have very positive news from FHA that in those cases they would not consider a seller paid buyer commission to be an interested party contribution. We're hopeful to see from Fannie and Freddie hopefully a similar judgment soon, as well as within VA and USDA. And then there's also a specific problem to VA, which has been a long-standing rule in the VA program that a veteran cannot come out of pocket to pay a commission, period. So in a market where, if it becomes the custom where shifting to the buyer paying out of pocket, or on the net sheet, it comes from the buyer's side to pay that 3% or 2.5% or whatever it is for the buyer's agent, the veteran cannot currently do that under current VA requirements. So that almost certainly has to change in the near term. We sent a letter to VA last week encouraging them to change that to allow a customary and reasonable commission paid out by the veteran. But I guess, I would, as I said at the top, a lot of it is still too early to tell, and different markets will handle it differently. In the markets where it's still a really strong seller's market, that obviously will have an influence on all of this. Softer markets will play out differently, and customs are different, and all the MLSs can be a little different. So that's, I guess a long way of saying we'll see. But I think we're skeptical that it ultimately results in a huge amount of reduced commissions at the end of the day. Certainly don't think it will result in lower housing prices. But I'll stop there. I guess that's our current base case.
You don't see anything formulated where in these situations where the property's being financed, that the lender's going to have obligations to monitor the commission of what's financed versus what's not financed for the commission, like the lender now being the police officer and making sure that the realtor commissions are all legal. Do you see that just being regulated by their regulators, and then, hey, they get to say, hey, whatever is being financed in the contract is being financed in the contract, and that's held separately? Or how's that thought of?
So again, that's why we've been pushing early on the definition of interested party contributions, because there are underwriting guidelines around what percentage can be a seller concession, right? So we don't, if in a world where suddenly agent commissions are labeled as a seller concession, then lenders would have to count it. So it's important that we continue to treat them the way we always have, which is they're not actually part of the home buyer, the borrower's calculation. There's been some, we've looked into points and fees, the CFPB, QM rules. There's a little bit of discussion there. Probably okay, but there's a lot of creative thinking about, does that potentially break QM points and fees? It may or may not. I'm still looking into that, but certainly I think more negotiating up front over commissions. But the actual effect of the net sheet, in my personal opinion, is you won't see a whole lot changing. There can be some situations where in order to make the deal work, the buyer just goes up a little higher with the price, and then the seller concessions it out. There's a little bit to unpack there around the impact that has on transfer fees and making sure the appraisal comes in at the right price. But But yeah, I think markets will be creative in ways to still, make the deal work. There's still the underlying, I think, supply challenge which is going to give the seller still a lot of influence. They have multiple offers coming in. Um, they're going to have more leverage, and that may mean there's less change in the marketplace. So,
Do you feel like there's going to be this appropriate, let's call it appropriate reflection time to understand the consequences of this, because it's a very, you make one little change in the mortgage ecosystem and it has profound impacts, appraisal, credit, reporting, and most politicians probably don't understand that, and even a lot of people writing the laws don't quite understand that. Do you think there's going to be this appropriate reflection time for them to provide some sort of safe harbor as these changes are getting implemented, or there's some sort of testing or feedback that they're getting so they can cover these situations? Because I could see this being, hey, they make one little change in the wrong direction and things come to a halt because they're scared they're going to get, people are scared they're going to get in trouble for doing it wrong.
yeah. So I think the changes are already starting to take place in the market, right? We have started to see a little bit of deal kind of, and this is anecdotal in a few markets, but the way that certain buyer agency agreements are drafted is started to change. I think though, this will be a gradual play out, and again, it's hard to give an overarching what will happen, because I do honestly think there will be some markets that don't see a lot of change at all, and some markets that do. But definitely would encourage folks not to read too much into the articles that represent that this will be a sea change for everyone immediately. I think the real answer is certainly a lot more nuanced than that.
Yeah, no, my head starts to spin when I start thinking of, builder concessions and, how different home builders structure their deals, and, they have representation and they own the title company, or they may own the real estate organization that's selling the transit. Like, I think there's definitely, some education and things to watch there, as it applies to new construction or even renovation. But, that's great to know. Now, more specifically in your world, any hot topics you see coming down the pipe that are specific to construction or even to, consumer renovation loans?
Sure. So, I could talk about both. I guess I'll start with renovation. We've been very, very vocal advocates that the FHA 203K renovation programs are not being utilized nearly as much as they can be. And a lot of that is because of the current program requirements around 203K. And in particular, the limited K, where you don't need a renovation consultant to do the deal. The cap, which until very recently, the maximum draw you can do was 35,000, and that hadn't been changed since 2005. So how much in 20 years have the cost of a renovation increased? How much have home prices appreciated in 20 years? And so why hasn't that number changed? The cap on how much you can draw out for a renovation, we think that needs to be much higher and should be indexed to inflation, so we don't have to go back and change it again. Because how much can you really renovate for 35 grand on a lot of homes? It's going to be a smaller renovation. And so fortunately, we both, formally submitted multiple comment letters to FHA and also had informal conversations with the FHA team about it. And they have proposed increasing that cap to 50,000 and 75,000 in certain high cost areas. Now we're arguing that should be 75,000 across the board and indexed, because what's the harm in allowing more renovations? There's such a huge population of outdated, dilapidated homes that aren't going on the market today because they need some TLC. But if you don't have the ability to inject into the financing more than 35 grand to update them, that's just a program that's underutilized. And the proof of the underutilization is that in last year, we looked at this, only 4,000 203K units were originated, period. 4,000 units nationwide. And that's even if you adjust for volume, 10 years ago, it was about 3 times that. So the program's being structurally underutilized. It has less to do with where rates are at. So improving those programs, not just the cap, but also things like there's no renovation consultants anywhere that anyone can find. So do we really need to still insist on the renovation consultant? Things like the requirement that you go directly to the manufacturer and say if it's a smaller deal, the consultant or the actual person doing the renovations can't just go to Home Depot or Lowe's and get the materials and get it done that day. You insist on going to the manufacturer. That drives up costs and slows it down. So looking at a lot of those types of requirements that, again, it's prioritization. We understand that they're why they're in place, right, for anti-fraud, waste and abuse, and things like that. But in a market we're in where it seems like the administration ought to be desperate, and they've told us they are, to find ways to help affordability. Those are, in our view, low-hanging fruit. So that's in the renovation programs, and would invite folks to look up on our website. You can see the letters we sent to FHA on renovation lending. On construction lending, we've in the last couple of years had a working group that's specifically looking at what are the regulatory hurdles to doing more construction financing. Our membership in the single family space, again, like I said at the top, we've got lenders of all shapes and sizes, but particularly for the independent mortgage banker business model, there's basically no way to do a construction loan unless there's a way to securitize it and pool it up front, right? Because if they're borrowing their funds on a warehouse line, there's no way to hold for a draw period unless you're willing to, premium price it like crazy to cover that interest rate risk. So what we really are looking for is a immediately poolable single close construction to perm program that would be delivered to Fannie and Freddie. We know that USDA has such a program, which I know you know a little bit about. And we love that. USDA is like the poster child of what could be possible. And we've been kind of railing on FHA and VA. If these all go into a Ginnie security and USDA can do it, why can't FHA and VA do it? And the reason is there's certain statutory limits that FHA has around what type of property is insurable within the FHA program. But from a policy, standpoint, if you can already do an FHA renovation loan where you're borrowing based on the future value of that property, how is it any different if you're doing that building a new home rather than starting with an existing home? I understand you need a statutory change, and we can work on that. But from a policy standpoint, that also seems like a reasonable change to make. And then in the VA program, they've got certain rules around the percentage that's guaranteed that iterates over the time of the construction period, which makes it functionally impossible for them to guarantee a new construction loan. But again, those are all things that are fixable policy issues. It's just a question of whether there's a will to do that in Congress and from the administration. If statutory changes needed, it would take Congress. But if you have an FHA construction loan, like single close, like USDA, that opens up to a huge, broader chunk of lenders the ability to offer construction financing without having to do like a TPO agreement with a community bank, which in practice is the only way that an IMB can do a construction loan. Or they do, an initial draw period with just an IO, and then they convert it to a full and deliver it to the agencies as a completed property. But being able to do the single close up front, we think would be a game changer. The GSE's posture on the ability to do a single close product is that they think it's a charter issue. In other words, the congressional charters of Fannie Mae and Freddie Mac do not allow them to purchase loans that are made to properties that don't have a residential purpose. And they have subsequently defined that to mean if there's not a house on the property, then they can't buy it. I think in my read, there's a little bit of wiggle room there. And even if even if I'm wrong, Congress could change that. You could create the ability to build on vacant land, something that becomes a home. And that's clearly, the GSEs were designed by Congress to facilitate home ownership. And so have they become, less able to adjust and remain nimble to the market challenges? I think is a fair question, because it seems like we should all be aligned on this, that we need to build more homes. There's ways we can get there. So those are the things that our construction lending working group has been working on. Those are like the big, holy grail type things, because we recognize getting from here to there is significant. Doesn't mean it's not worth trying. But we've also been doing some more nibbling around the edges, looking at the current seller servicer guides at the GSEs for lenders that do a type of, IO converted to a full, then delivered once the construction's done. Is there a way to stretch the time it takes, or the period before you have to redo the entire underwrite, which is generally 12 months? Is there a way to extend that to 18 months? So that if you've got a borrower that's current and paying and fine, you don't need to incur the cost of doing a complete additional underwrite before delivery. That could be helpful. Things like that. And so
updating the credit, income, and assets within that, I think it's not 180 days, it's 90 days or 180 days. That's absolutely ridiculous. The IMB has already made the loan. Everybody's already committed. What's the point? I understand why, but I think that little point of contention right there is just, banging your head against the wall. Like, why? Just fix this one little thing. But how big of an impact, hearing that the construction lending working group, how big of an impact would it be if tomorrow Fannie Mae, Freddie Mac, VA, FHA start buying these construction loans? What kind of an impact are they expecting that to make?
Well, it's hard to do the math on that because it's kind of a theoretical, but certainly in my view, it would open up, particularly to custom builders, the ability to do more deals, because a lot of the majority of origination volume today is done by IMBs. And if they're completely shut out from really being able to do with their current model, a construction loan, and now you can, because there's an option to securitize it, it brings the cost down of building. I think it would be a very significant needle mover, certainly like we've talked about, in a world where the best thing we can possibly do is build more housing and speed that up. That seems like the central issue on how you help the marketplace. And particularly because Congress always worries about what things cost. If there's ways that you can do, I don't think this would cost the government anything. In fact, it would arguably make money for the government if the GSEs can start buying some of these loans that begin with vacant land. Again, on this particular issue, this is my personal opinion, but I think it would be a huge needle mover. It's just a question of willpower, whether it can be done without Congress, whether it can be done as a reinterpretation of the congressional charter, or if need be, do you make changes congressionally to what the GSEs are able to do? If this is this much of an emergency in the American economy, at some point you got to ask that question.
Yeah, it's interesting that, we see, State of the Unions where, hey, housing's really important. We see, politicians getting interviewed, and yeah, housings are, really, really important to us. But then we see laws and regulations about, energy efficient ruling coming out that squash all that and kind of go in the other direction. It would be just amazing to have something like this because it's really impactful. What I would give to be watching a State of the Union and the president up there saying, hey, and we've instructed FHFA to direct Fannie Mae and Freddie Mac, and the GSEs are going to do their part, as well as VA and FHA. We're going to start buying construction loans and insuring construction loans immediately. It's like, wow, I would throw a party. I would go to DC just to watch that, and I think that would make such a profound impact on our housing supply. Providing the financing conduit to facilitate those transactions. I think it's huge, and just amazing work that you guys are doing and sponsoring that working group. Anything else on the construction or renovation front that you guys are tackling or paying attention to?
Well, first, I'd be right with you at that party dancing because I agree that would be a huge deal. And I think, there's just a lot of cooks in the kitchen in the government, and everyone in every agency is very passionate about what they do and believe in the cause. And it's a question of the administration choosing its own priorities, right? Um, in terms of what more, I talked a little bit about our construction lending working group. I would encourage anyone that is an MBA member, if they're not a member, to become a member, of course, but if they are a member, reach out to us and we can get you plugged into that working group. It's a very kind of open roundtable discussion about, are we missing anything? Are there opportunities that, folks that are in the field are thinking, man, if it just worked this way, well, that's the role we're in, is we could change it so that maybe if enough people agree with that idea, we can get it changed in the short term and the long term. So would welcome anyone that wants to participate in that exercise to join us. And we do have conversations directly with the agencies about it as well. So it's not just us kind of sometimes it's us internally, but we also have these conversations with the agencies, and they know where we stand on it too. So just a cheap plug there for people to get involved.
Absolutely love the work you guys are doing. This is just super informative. I myself am learning a lot just sitting here talking to you. Really appreciate you, going over all of these subjects and kind of keeping us in tune to what's happening through the MBA lens. As we near the end of our podcast here, we have this section called the rapid fire, and you got a little heads up that this is coming. But if you're ready, I'll go ahead and start shooting.
Let's do it. Shoot.
All right. Any book, this is an interesting one. Any book or movie recommendations that you've watched a movie recently or a series that you would recommend to others?
Well, I've got young kids, so we don't get out very much, and I don't read as much as I used to. I got great recommendations on YouTube videos for 2-year-olds, although that's probably not healthy for them. But we did see Oppenheimer a month ago, and I agree with kind of this is a very majoritarian viewpoint, but I agree with it. It's a very good movie, well worth the watch. I have not seen Barbie, although my older daughter will probably drag me to see it eventually.
Seeing both of Oppenheimer was really well done.
Yes.
Just was absolutely impressed by the work that they did there. Any podcasts that you listen to?
I listen to a lot of podcasts. And my main news source is Twitter, and the people you follow on Twitter, I think, kind of influence. You can kind of curate your own, but Breaking Points with Crystal Ball and Sagar and Yeti, I have found to be one that I listen to a fair amount. They have kind of a anti-establishment viewpoint. They're willing to attack both sides of the aisle, and I think speak as a millennial. They're both millennials and kind of speak to, and they talked about housing issues a lot on their podcast. So I have tuned into that one quite a bit.
Wow, I got to check that one out. I will definitely check that out. I'm a big podcast fan, as you could probably tell. One of my favorite questions here, and this is so self-serving to me, but I always like to ask if there's a favorite product that you've recently discovered that you would recommend to people. And for example, I really love my Roomba, vacuum that's got the AI and goes all over the house, and how smart it is now, and just love watching the dang thing. But my most favorite is my Ember mug. To have a cup of coffee at the same temperature through the entire day is just amazing to me. Do you have like a product that you've recently fell in love with that you can't live without?
What my mind went to when you showed me the mug was, my wife has one of the Stanley cups, and I just don't, I did not see the appeal. And then everyone at work started having Stanley cups, and it's like a cult thing. I don't get it, but I think I might be converting. It's just, I don't know. I find that I'm drinking from my wife's Stanley cup all the time, and I may get one myself soon. I don't know. I'm starting to become a believer.
my wife loves hers. And what's interesting is our 2 5-year-old boys, I just see them, they'll run into the room or run into the kitchen and pick up her Stanley mug and start drinking from it. And I'm like, well, why aren't you guys using your own cups? You know, it's like, well, mom's
There's
is
something about it. Something about it. You can't, it's intangible, but as long as you just have one, if you get multiple, then I will probably remain critical.
All right. Would you ever build your own home?
Yeah, if costs come down, which I guess is a nice cap on everything we talked about. My wife would love to build a home. I think just looking at the cost today, though, we're going to need an assist with that for sure.
There's something romantic about like being able to think of all the things that you want. And, you know, when we have conversations about, you know, kind of the differences between going out and buying an existing home or, you know, somebody building their own home, there's this key difference that, you know, most people aren't in tune to. And that's the emotional attachment that somebody has when building. You're so emotionally invested and committed to that situation versus, you know, purchasing a home that somebody's already lived in. Even if it was a brand new home, they're just different animals. And something special about being able to kind of plan it out and have influence over what it's your home, right? Not somebody else's home you're buying, but it's your home. And there's something special about that. So I always love asking that question. Now, last question here, and this one's, you know, designed specifically for you, is, hey, if you could change one piece of legislation or create one piece of legislation out there and just snap your fingers and tomorrow it's in place, what would it be?
Oh, picking one is hard. I would say Dodd-Frank probably would be the biggest one. The pendulum swung so far in the direction where now there's a lot of really qualified people that a local community bank would make a loan to with its own money, but you can't do. We ought to be able to bring the pendulum a little bit back the other way, in my opinion. So you can serve more people and get people on the homeownership ladder. There's a lot of, you know, protections that were important in Dodd-Frank, but if there's a way to rationalize it more, I think there's plenty of opportunity there. And then you can help more people and being able to go from renters to buyers.
Well, this has been absolutely fantastic, Matt. I can't say thank you enough for joining us on the podcast today. I learned so much, and this is definitely going to go down in history as one of my favorites, but really appreciate everything you've done for us today. If others wanted to get in touch with you and reach out, what's the best way to contact you?
Feel free to reach out directly. I'm Matt Jones at mba.org. And
you got a LinkedIn profile?
Yeah, I'm the only Matt Jones on LinkedIn. So maybe Google Matt Jones MBA.
What are the odds, right? But hey, thank you very much. We'll include all your contact information at the bottom of the podcast here. And you have a great day and hope to see you on the show soon.
Thanks so much for having me. I enjoyed it.
This podcast is intended for educational and informational purposes only and does not replace independent professional judgment. Land Gorilla Inc. makes no representations, warranties, or promises for and disclaims any express or implied warranties related to content. Before acting on any information, you should consider the appropriateness of the information as it pertains to your unique business needs.